Which of these correlation coefficients indicates the weakest relationship between two assets? Right? So the weakest relationship is the one closest to 0. How about if I say, which of the following indicates the strongest relationship? What would you say? So Serge got the trick. So it's A and D. So the strongest relationship are these two. Of course, you won't get that in the exam. I was just testing you. So a strong relationship, we're not saying positively or negative. We're just saying a strong relationship is the one that is closest to perfect. So these are the strongest relationship or strongest correlation. Nice. Moving on. Which of the following funds might have the highest level of gearing? Gearing or leverage or debt? Bond funds, equity funds, money market funds, or property funds? Right? So property funds. And in case you are asked in the exam, they can have up to 90% leverage. Moving on. Insider dealing rules apply to which of the following securities? Aluminium futures, OIC shares, bond futures, unit trust units. So, insider trading or insider dealing. Insider trading or insider dealing rules, you have to remember these. They come in the exam. They apply to shares and bonds and derivatives on shares and bonds. Options, futures, warrants, swaps on shares and bonds. They do not apply to of course apply to shares, bonds, and closed funds. Sorry, closed-ended funds. Because closed-ended funds are listed companies. A closed-ended fund is traded in the stock market and it's a limited liability company. Insider dealing laws do not apply to commodities. They do not apply to derivatives on commodities. And they do not apply to open-ended funds. So which of the following apply to? Aluminum futures, this is a commodity. It's a derivative on a commodity, so it does not apply to. OIC shares, OIC are open-ended funds, so these do not apply to it. Bond futures, yes, they apply to it because it's a derivative future on bonds. So insider dealing applies to it. The unit trusts are open-ended funds. Open-ended funds, insider dealing does not apply to them. Moving on. If a government decides to deal with the current account deficit by allowing the value of its currency to decline against other currencies, what will be the impact on a company? It will reduce its cost for importing raw materials. The cost of services it obtains from abroad will be cheaper. Profits earned in other currencies will be worth less when translated into sterling. Its goods will be more competitive in overseas markets. Right? So if current account deficit, the government is trying to pay for the current account deficit by devaluing its currency. So when the currency loses value, goods in the country become cheaper compared to other countries. So people will come and buy from that country. It's one of the tactics countries use in currency wars, in trade wars, which is the biggest problem that Trump has with China, right? So when the currency declines, goods in that country become cheaper, you become more competitive. That means you're able to attract more customers. That's right, Muhammad Sawan. Although China denies that they are manipulating the currencies, they are devaluing the currencies, everybody knows that they are. They never confess, but they do. You calculate that your client will need to generate an income of $20,000 to meet her retirement needs. If she can earn 5% per annum, then how much of a lump sum will be needed in 10 years' time if inflation is expected to be 4%? Let's take a minute to calculate. So, of course, this is a two-stage calculation. The first stage is the future value of the income. So, if he needs $20,000 of income now, how much will he need, or she needs, sorry, in 10 years' time? Now, $20,000 in 10 years, how much is it valued? Well, we need to look at the inflation, right? How much is inflation? 4%. So the future value of this $20,000 which she needs to spend is 1 plus 0.04 to the power 10 years. And this should give you 29,604. What does this mean? If this client needs $20,000 of income now to cover her expenses, in 10 years' time, she will need $29,000 to cover the same expenses, considering inflation is 4%. Good. Now we know how much she needs in income. Well, how much should she invest in order to generate this income? Well, the second item is the value of the investment. So how much should she invest in order to generate $29,000 every year? If she's earning 5%, well, it's easy, 29,604 over 5%. This is going to give you somewhere around 592 something. So the answer is C. I think the answer is 59267 or something. Let me check. 592097 if you want to be accurate. Right, moving on. Fund ABC was valued at 10.5 million at the start of the year and 11.8 million at the end of the year. The asset allocation was 60% equities and 40% bonds. If the fund's benchmark assumes a 50-50 allocation, and over this period, equities achieved 7% increase and bonds achieved a 5% increase, then the fund will have, now we need to know whether the fund has underperformed the benchmark or outperformed the benchmark, and by how much. Let's do the calculation. So, right, so let's solve it together. So we know, so we know that the fund ended the year at 11.8 million. It started the year at 10.5, but ended the year at 11.8 million. Now let's see how much the benchmark would have ended the year and see whether the benchmark was better than the fund or the fund was better than the benchmark. So the benchmark was distributing 50-50. So half of the money was into equity and half of the money of bonds. So 10.5 million, the benchmark would have put half of that money in equity, so 5.25 in equities and 5.25 in bonds, if we followed the benchmark. And now it says here that we did not follow the benchmark. So if we followed the benchmark, could we have done better or could we have done worse? So if we had followed the benchmark, we would have put half of the money in stocks, half of the money in bonds. Now the stock market made 7%, so it grew by 7%. So an quick way is to just add 1 to it. So that means if we have done the benchmark, our equities would have become 5.6175. And the bond market, it grew by 5%, so times 1.05. So this would have become 5.5125. So 11.3. This means if we had followed the benchmark, we would have ended the year at 11.3. But the fund manager didn't follow the benchmark and he ended the year, 11.13. And he ended the year at 11.8. So the fund outperformed the benchmark. So this is wrong, this is wrong. So he outperformed the benchmark by how much? He made 11.8. The benchmark made 11.13. So 11.8 minus 11.13 is going to give you 0.67. So of course this is millions. So he outperformed the benchmark by $670,000. Moving on. Which of the following is an indication of a successful active fund and a well-diversified portfolio? A low trainer ratio, a high standard deviation, a high Sharpe ratio, a low information ratio. Right? See? Now, all of these are what we call risk adjusted returns. Right? So these ratios, the Sharpe, the trainer, the Sortino, the information ratio, all of these, the higher the better. The higher the better. Because the higher the ratio, the more successful and expert the fund manager is, and the better diversified the portfolio is. So a low trainer ratio is a bad thing. High standard deviation, standard deviation is measurement of risk. It's not an indication of performance. Also, high standard deviation means low diversification. Remember, the more you diversify, the lower the standard deviation of the portfolio. You get to a point when you achieve maximum diversification, your standard deviation of the portfolio becomes zero. And when the standard deviation of the portfolio becomes zero, the only risk of the portfolio remaining is the beta. The whole point of the modern portfolio theory as a theory is for you to invest in so many different stocks, believed to be around 30 different stocks, in different sectors, in different countries, in different areas. And by investing in these different stocks, the standard deviation of the portfolio goes down, goes down, goes down until it becomes zero. Now, for it to become exactly zero is almost impossible, because for a portfolio to have a zero standard deviation, the assets in the portfolio should have a correlation of -1. And that correlation of -1 is almost impossible to find. And because it's impossible to find assets which have an exact correlation of -1, it is impossible to build a portfolio with exact zero standard deviation. But we can get very close. So, a sign of a well-diversified portfolio is where the standard deviation of that portfolio gets so close to zero, the only thing the fund manager has to worry about now is the beta, which is the market risk. He won't have to worry about the individual risks anymore. Sharpe ratio tells you that. Because Sharpe ratio is usually linked to standard deviation. And standard deviation is linked to diversification. Right? Low information ratio also is not a sign of a successful fund manager. It's a sign of a bad fund manager. Sharpe ratio, just to remind you everyone, is calculated as follows. The return of the portfolio minus the risk-free return over the standard deviation of the portfolio. The information ratio is calculated as follows. In many different ways. Just quickly, is the return of the portfolio minus the return of the benchmark, not the risk-free, over the tracking error. What the information ratio is trying to tell you is that this fund manager achieved this return because he is intelligent and an expert, or because of luck. It looks at the consistency of the returns. Is this fund manager consistently beating the benchmark because he is he is smart and experienced, or is because of luck? That's what the information ratio tells you. And the higher the information ratio, the better, the more successful the active fund manager is. So a low information ratio is a bad thing. It's not a sign of a successful active fund manager. So the answer here is a high Sharpe ratio. We've basically just summarized for you portfolio management and risk and return. Moving on. The ongoing charges figures and the total expense ratio is used in conjunction with which of the following? A, analysis of company accounts. B, comparison of collective investment schemes. C, selection of discretionary investment management providers. D, performance measurement of a portfolio. Yes, that's pretty easy. So ongoing charges and figures, OCFs, and the total expense ratio, the TER, these are usually used in funds, right? So comparison of funds. Notice here CISI puts collective investment schemes, they mean funds. So that's the answer B. Moving on. An investor buys a call option for 10 pence on ABC ordinary shares exercisable at 100 pence in 3 months' time. The underlying share price is 120 pence. The option is described as which of the following? Break even, at the money, in the money, out of the money. So let's go through this quickly. Just a quick reminder, at break even is where in a call option, the exercise price plus the premium, this is a call option, not a put, equals to the market price. At the money is where the exercise price equals to the market price. In the money, since it's a call option in the money is where the holder benefits. And the holder benefits in a call option where the exercise price is less than the market price. Exercise plus premium. If CISI gives you premium, add it there. Out of the money for a call option, well, also for a put option, is where the holder loses. And this is where the exercise price plus the premium, which is the total cost of the option, is higher than the market. In this way, the holder of the option will have to cancel the option. So the investor buys and pays 10 pence. So the premium is 10 pence. And the exercise price is 100 pence. So all in all, this option is costing, or this stock is costing the client or the investor, the holder, a total cost of 110 pence. So he has the right to buy with a total cost on him of 110. On the exercise day, or on the maturity day, the price of the stock was 120 pence. So will this investor, this holder, will he go and buy the asset at a total cost of 110 from the writer, or will he go to the market and get it for 120? Obviously, even with the premium, this option and this stock is still cheaper for him. So it's better for him to exercise. So because this option is still in the favor of the holder of the option, and he is going to benefit, this option is called in the money option. Moving on. Which of the following is a characteristic of whole of life assurance? It can be arranged as level, increasing or decreasing. It is a liquid source of investment. It can help with the cost of long-term care. It combines an element of insurance with a savings plan. So, whole of life, of course, when we talk about life insurance or life assurance, these can be separated into two, into whole of life and into term assurance. So hang on for a second, please give me a second. Let me check something quickly. Sorry about that. Let me go back. So life assurance or life insurance is divided into two, whole of life and term assurance. So which of the following is the characteristic of whole of life assurance? It can be arranged as level increasing or decreasing. That's false. This is a characteristic of term assurance. It can be level, well, the premium and the payout are fixed. It can be increasing, where the premium and the payout are increasing, or it can be decreasing, as in the case of a mortgage, where the premium is fixed and the payout is decreasing. B, it is a liquid source of investment. No, it's not, because usually this is a long term and it's tied into insurance and investments. It's not liquid. It can help with the cost of long-term care. No, whole of life usually does not include an element of long-term care. Long-term care is attention or care when you are old, usually in nursing homes. It combines an element of insurance with a savings plan. Yes. D is the right answer. A stock has a beta of 1.2 and is being traded in the market that is expected to grow by 3%. What is the stock's CAPM considering the treasury bills have a return of 2%? Let's calculate it quickly. So CAPM. What is CAPM also called? What is CAPM also called? Well, it's also called expected return. Expected return of an investment based on its beta equals to the risk-free rate plus the market return minus the risk-free rate times the beta. Another question. Market return minus the risk-free rate. This bracket here, this, what do we call it? There is a name for it. This market return minus the risk-free return. Market risk premium. Right, market risk premium. Awesome. So the risk-free rate is 2%, which is treasury bills, plus the market return is expected to be 3% minus the risk-free rate, again 2% times beta, which is 1.2. Of course, in math, we finish with the multiplication first. So 1 times 1.2 plus 1.2. This is going to give you 3.2%. So the answer is C. Right, moving on. When an investor believes that something will not occur in the future because it has occurred many times in the past, this is called herding, overconfidence, representativeness, gambler's fallacy. Right? So if he believes that something will not occur in the future because it occurred so many times in the past, that's called a gambler's fallacy. If he believes that something will occur in the past, in the future, because it occurred so many times in the past, that's called representativeness. If that's what the question is. So if he believes it will occur, then the answer would have been representativeness. But it will not occur, so the answer is gambler's fallacy. Which of the agencies rates the performance of fund managers? Moody's, Morningstar, Lipper, Citywire. Right? So Citywire rates the performance of the fund manager, whereas the others rate the Moody's. I don't think Moody's has a rating for funds. Moody's is a credit rating agency. It's for bonds. Morningstar and Lipper, they rate the fund itself, whereas Citywire rates the fund managers. Moving on. Which of the following correlation coefficients indicates the lowest level of diversification? So, the lowest level of diversification is where there is the highest correlation. Highest correlation. So which one is the highest correlation? Highest correlation means that they move in the same direction. That means if one of them drops, the other will drop. So you're not diversified. A high correlation means a low diversification. And because it means a low diversification, it means high risk. So the answer is A. Moving on. Which one of the following ratios uses beta to calculate risk? Sharpe ratio, Sortino ratio, Traynor ratio, CAPM. 1 and 2, 2 and 3, 3 and 4, 1 and 4. Right, so Sharpe is the return of a portfolio minus the risk-free return over the standard deviation of the portfolio. So it does not use beta. Sortino is the return of a portfolio minus the risk-free return over the standard deviation of the drawdown. What is the drawdown? The drawdown are the years where the fund performed negatively, had a negative return. Sharpe ratio looks at the standard deviation across all years. The years where there was a good performance and the years there was a bad performance. Takes the standard deviation of all years. Sortino takes the standard deviation only for the years where there has been a negative return. Again, uses standard deviation and not beta. Traynor uses beta because Traynor is the return of the portfolio minus the risk-free return over beta. So Traynor uses beta. And CAPM is the risk-free rate plus the market return minus the risk-free rate into beta. So it's 3 and 4. Moving on. In a trust, the remainder man receives the capital after the death of the settlor, the death of the trustee, the death of the beneficiary, any of the above. Right, so here we're talking about a specific type of trust, which is the interest in possession. So in the interest in possession, basically the trust will be structured as follows. The asset will go to the beneficiary. Sorry, the income of the asset. For example, the house, the rent on the house, the income of the asset will go to the beneficiary during the life of the beneficiary. And then when the beneficiary dies, upon the beneficiary death, the asset, the capital itself, the house, goes to another person. That person is called remainder man. So the settlor who created the trust tells the trustee, give the rent of the house to, for example, my wife. And she's the beneficiary. And when my wife dies, the house will go to the children, who are now considered the remainder man. So the answer is C. That's right. Which of the following is used as an indicator for broad money in the EU? M0, M1, M2, M3. So we have, seems that lots of you are making a mistake. Narrow money, and they have broad money. So in the US, narrow money is M1 and broad money is M2. In the UK, narrow money is M0 and broad money is M4. In the EU, which is the question, narrow money is M1, and then we've got M2, which is intermediary, and then broad money is M3. So the answer is D. Moving on. For a bond that is trading at a discount to its par value, which of the following statements would be true? The gross redemption yield is less than the running yield. The gross redemption yield is higher than the running yield. The gross redemption yield is equal to the running yield. The gross redemption yield is equal to the coupon over the price by 100. So Muhammad wants to go back to the previous question. Sure, Muhammad. What's your question, Muhammad? Previous back, okay. This one? Is there any question, Muhammad? As the remainder man will receive the capital after the death of the life tenant, not the beneficiary. No, in this book it's the beneficiary. We use the UK model. In this book it is very clear that the remainder man will get the capital at the death of the beneficiary. That's what it says in the book. Keep that in mind for the exam. In this exam is the remainder man gets it at the death of the beneficiary. There is no life tenant. A life tenant is what you use in the UAE, I think. In the book, the three things that you need to know is the settlor, the trustee, the beneficiary, and then when the beneficiary dies, the remainder man gets the capital. I don't remember the word life tenant in the book. Moving on. So for a bond that is trading at a discount to its par, it means that on redemption, there is a capital gain. And because there is a gain on redemption, the redemption yield is higher than the annual yield. So the gross redemption yield will be higher than the annual yield or the running yield. So it was a question in one of the videos. Probably we'll check the book. Let me check the book quickly. I don't have the book on me now, but I'll check it for you. Remind me on WhatsApp or post a question of it on the portal and I'll answer it. Probably I forgot. Moving on. Which of the following is true of long-term care cover? Covers medical costs after 70. Tax is paid on proceeds paid out. Proceeds are paid as a recurring income. Premiums tend to be cheap. Right? So long-term care covers medical costs after 70. No, I think it doesn't cover it's long-term care. Is you living in a nursing home, of having somebody take care of you in your house. That's long-term care. And not necessarily after 70. It can be whatever year I think you put. So that's wrong. Tax is paid on proceeds paid out. No, it's not. There's tax relief. Proceeds are paid as a recurring income. That's right. Premiums tend to be cheap. Nope. Premiums tend to be expensive. Which of the following is true of negative interest rate policy? It encourages people and businesses to save during crisis. It encourages people and businesses to spend during crisis. It is usually accompanied with contractionary fiscal policy. It is usually accompanied with expansionary fiscal policy. Right? So negative interest rate policies is where interest rates become negative. That means if you deposit money in the bank, you won't earn money on it, you will lose. So why does the central bank do that? It does that so that it discourages you to save. They don't want you to put your money in the bank. They want you to spend and invest your money. That's why they charge you interest. You have negative interest rate on your deposit. So it encourages people to spend during crisis. And usually when there is a crisis and negative interest rate, it is accompanied by a expansionary fiscal policy from the Ministry of Finance, where tax is reduced and government spending is increased. So it's 2 and 4, so the answer is D. Like Muhammad Salman, yes, adopted in Corona times. Which of the following influence a client's attitude to risk? Timescale, stage of life, commitments, comfort with risk. This is our last question for today. Right, D. Comfort with risk. This is attitude. It's very important. Sometimes called appetite for risk. It's our subjective. These three are under the capacity, risk capacity, otherwise called risk ability, and these are objective factors. Right.